Most people buy things backwards. They see something shiny, they feel an emotional impulse, usually excitement or FOMO, and they swipe their card. Then, they spend the next month justifying the purchase or regretting it when the bill arrives. That is the poor way to buy. And I don't mean poor in terms of how much money you have right now. I mean a poor mindset that keeps you broke. Wealthy people, they operate completely differently. They don't just have more money, they have a totally different operating system for spending it. They have rules. Today, we are breaking down this incredible blueprint, how rich people buy. We are going to cover the 6 fundamental rules that shift you from emotional spending to strategic wealth building. Let's dive in. Rule number 1, value over price. The average consumer is obsessed with the price tag. They are always looking for the cheapest option, the discount, the sale. They think saving $50 today is a win. The wealthy buyer knows that price is what you pay, but value is what you get. Look at this watch example. A poor mindset buys a $50 watch every year because the cheap ones keep breaking. Over 10 years, they've spent $500 and have nothing to show for it. A rich mindset buys a $500 quality timepiece once. It lasts 20 years, looks better, and might even appreciate in value. The upfront price was higher, but the long-term value is vastly superior. When rich people buy, especially big-ticket items like real estate or businesses, their first question isn't, how much does it cost? It's, what is the return on investment, ROI? If the quality isn't there, the low price doesn't matter. Rule number 2 might be the most boring, which is why most people skip it. Research and due diligence. Emotional buyers skip the fine print. They trust the salesperson. They assume everything will work out. They buy based on a headline. Rich buyers are skeptical detectives. They assume nothing. Before any significant purchase, they enter a phase of intense study. If they are buying a property, they aren't just looking at the paint color. They are inspecting the foundation, researching zoning laws, checking neighborhood crime stats, and analyzing future development plans for the area. Due diligence means doing the homework required to know exactly what you are getting into. It's the insurance policy against making a stupid mistake. If you don't understand it, you don't buy it. Period. Rule 3. Buy assets, not liabilities. Invest in things that grow. This is perhaps the most famous rule, popularized by Robert Kiyosaki, but it is essential. Buy assets, not liabilities. Let's simplify this. An asset is something that puts money in your pocket. A liability is something that takes money out of your pocket. The image nails this. A brand new sports car? For 99% of people, that is a massive liability. The second you drive it off the lot, it loses value. Then you have insurance, gas, maintenance. It is a cash-sucking machine. Rich people focus their buying power on things that grow. Real estate that appreciates, stocks that pay dividends, businesses that generate profit, gold that hedges against inflation. They only buy the luxuries, the liabilities, using the income generated by their assets. They don't use their seed money to buy toys. Rule 4. Think long-term. Future gains matter. Rule number 4. Think long-term. We live in an instant gratification society. We want it now. Poor buying habits are driven by the desire to feel good today. The wealthy operate on a completely different time horizon. They are willing to sacrifice comfort today for massive gains tomorrow. They understand compounding. They know that planting a financial seed today might not look impressive for 5 years. But in 20 years, it's an oak tree. When they look at a purchase, they ask, will this matter in 10 years? Will this help my future self? If the answer is no, they usually pass. They are playing the long game, while everyone else is playing tic-tac-toe. Rule 5. Negotiate everything. Get the best deal. Rule number 5. Negotiate everything. Most people are terrified of negotiation. They see a sticker price and they accept it as gospel truth. They think it's rude or cheap to ask for a better deal. Rich people understand that in business, almost everything is negotiable. The sticker price is just the seller's starting offer. Notice in the image, it's a handshake over a contract. Negotiation isn't about being aggressive or nasty. It's about finding a win-win scenario where you get the best possible terms. Whether it's interest rates on a loan, the price of a commercial property, or vendor contracts for their business, they ask. The worst someone can say is no. But you'll be amazed how often they say yes just because you had the confidence to ask. And finally, rule number 6, cash flow focus. Many people obsess over net worth, a theoretical number on a piece of paper. Rich people obsess over cash flow, the actual money moving into their bank account every month. When they buy something, they want to know, does this purchase generate income? They prefer a rental property that pays them $1,000 a month in profit over a piece of raw land that just sits there doing nothing, even if the land might be worth more someday. Cash flow pays the bills. Cash flow gives you freedom today. They focus on widening the gap between their income and their expenses, and then taking that difference to buy more cash-flowing assets. So, there you have it, the 6 rules. But if you only remember one thing from this entire video, remember the banner at the bottom of that infographic. Don't buy on emotion, buy on strategy. Stop letting your feelings dictate your financial future. Start using rules. Which of these 6 rules do you struggle with the most? Let me know down in the comments. And if you want to build your financial strategy, make sure you subscribe to the channel. Thanks for watching, and happy investing.